Okay, Marty James here. So we've got our November economic indicator numbers up, and this time I want to kind of go back a little bit, look at where we've been, where we're at right now, and dive into a little bit more detail. So here's our numbers. So here's the November Astor Economic Index, and so this index is a proprietary product that Astor Investment Management actually produces on a monthly basis. Actually, they're doing it on a daily basis, but we get the information on a monthly basis. They put together, this based on a lot of different factors in the economy and data. But you can see here that these are the gray bars are recessions, and so we had like back here in the early 2000s, if you can remember that recession. And then of course we had the great financial crisis, that recession. But one thing you'll see that's common with these is that we see a trend happening, that okay, the economy's softening, and it can be kind of predictable as to are we heading towards a recession? And we can actually see it coming. And the same thing with the great financial crisis. We're slowing down. Here like in July of 2007. Of course, the high of the markets in 2007 was in October. But we had already come down and then proceeded into the recession. Why this is important is when we're up into here in this area up here, the economy is driving along really, really good and such, and we're less susceptible to economic shocks and these exogenous events that happen, like a pandemic, or a financial crisis of some sort that we just had. So when we look at kind of what was going on through the end of 2018 into 2019, you can see that we were actually getting a little softer. Okay, so obviously our radar was up and said, okay, we're monitoring this, what's happening and such. And then the pandemic shows up, which that, took us literally, if we look at like February of 2020, March 16th and such. And then, we went to the cellar. I've never really seen a straight line exactly like that. And so, with the efforts of, the Fed providing a lot of liquidity, and then we had Washington, D.C. throwing all sorts of money, at this. I mean, they had every kitchen sink out of every place, every building in Washington, D.C. that they threw at this. As a matter of fact, this is really like the first recession we've ever had where actually household incomes actually went up because of all the monetary stimulus that came in. Which that proved to work pretty well, especially as we started to reopening, as we started figuring this Mr. COVID thing out. So we started reopening, and we rebounded quickly. We're not completely back to where we were, but we have come up substantially. Now the issue is now, with this pretty incredible rebound, things are stalling out and slowing down. And so for this month, we actually ticked down a little bit, but it's not really a totally concerning picture yet. This was actually something I really would have expected. We have, a lot of the monetary stimulus coming out of Washington is dried up. The PPP loans for businesses, small businesses, has burned off their balance sheets. They've spent the money. We have a lot of the unemployment benefits and things that have are tapering out and actually stopped, for the pandemic unemployment insurance. So we would expect this. And one of the things that we are seeing that it is concerning is the unemployment claims. I think we had last week 853,000 claims for unemployment, which that's a large number by any means, but we'd actually been improving. But the last couple of months is actually starting as a rolling average. Those numbers are trending up, and 70% of the economy, is the consumer. And so if people don't have the ability to buy stuff, that's going to trickle all the way through the economy, and so we would expect to see us kind of stall out here a little bit and not have these huge jumps, and but likewise, as this thing kind of tapers here, I don't expect to see like large declines either. The way I kind of see this playing out, at this point is that okay, we have the vaccines, and but it's going to be a while before we're completely. Everybody's got their vaccination. I actually anticipate by the time I'm able to get in the line, it might be September. I don't know, but that's kind of what my thoughts are. So I really think that we're going to see like the first half of this year of 2021 be fairly soft, and a lot of this is because we're seeing a lot more shutdowns and such. Mr. COVID hasn't tapped out yet, but it's coming. But then I think you might see, because of all the pent-up demand, people want to go out to eat. People want to, they want to go places. They want to do things. So I think that second half of 2021, we could see a pretty decent rebound in economic activity. But the question becomes, once that pent-up demand is gone, then what? And will we staple out, or will we start heading back south again? So those are some things you just kind of think about that. Now, how does this relate to your portfolio? If economists, you talk to one, and that's why economists have two hands, because they say, on this hand, but on this hand, all right. So, but if anybody could tell you exactly what's going to happen in the economy, whether we're going into a recession or not, and can predict out that far, I wouldn't listen to them. But as far as your portfolios go, I think now's the time that you really do need to, because we have had pretty good recovery, that you really be needing to look at how you're positioned. Are there funds that you're going to be needing shortly that are invested very, very aggressively? The last thing you want to do is subject yourself to what we call sequence of returns risk. And what that is essentially when I'm taking money out of my portfolios for certain expenses, or just basically retirement living income, I don't want that money to be subject to a lot of volatility right now, because if I have $100,000 and I take out 4%, well, that would be $4,000. But if my account in there goes down substantially, it's more than 4% the next time I take that $4,000 out. So you want to mitigate that what we call sequence of return risk. And this is something we work really hard with our clients that we're doing financial planning with, is to be sure that as these events happen, that things don't change for them in the next 5 to 10 years. It's a good way to have some pretty good peace of mind. So I would really encourage you to look at your portfolios and say, okay, how much of this am I earmarking for some cash flow need that I have here in the near future? I wanted to drop down into here just a little bit to kind of show you the non-farm payrolls. You can see how they're popping up here, and then we are kind of tapering off a little bit. And again, the non-farm payrolls year-over-year percentage. So yeah, we're not back yet, by any means. And the question is, are we going to start picking up? There's still 10 million jobs that are still missing. So with that, I wanted to go over here to the initial claims numbers, and this is what's kind of disturbing a little bit. And it doesn't look like it's a big line. So you can see this is going back into 2020 during the pandemic, things shutting down, and then initial claims. I mean, look at these numbers. 5 million jobs or claims for unemployment. Then it starts tapering off, all the way through, which is that that's all a great sign. We get into here, we're 849 and 758. Things look like they're improving, and now we're starting getting this reversal, and to where here in December 5th. We were at 853. So this is something to pay attention to. But again, going back to the nowcast, the economic indicator does really gives us a good picture of what's going on. So with that being said, if you have any questions, reach out. Drop me an email. Give me a call. We can discuss this, and we can discuss maybe how you're positioned, and things maybe you need to be doing in your portfolios.